Good evening and welcome to our third revision session for the Management Accounting Techniques unit for the Level 3 qualification on the new Core 22 syllabus. Tonight we're going to be looking at a task relating to short-term decision making. It's quite a nice topic, very numbers based, as a lot of this unit has been. So we're going to look at things like break-even point, margins of safety, and also if we need to make changes to our budget data, changing prices of things for this, that and the other. So yeah, my name is Catherine. I'm one of the tutors here at First Intuition, and it will be my pleasure to walk you through what is required for task 3 this evening. So let's have a look. I'll have a look at a bit of a task briefing and then we'll get on to some questions. So first of all, we'll have a look at what is involved with this task. So as we said, task 3, we're looking at short-term decision making. So these are our things like how many units do we need to produce in order to cover our costs and possibly cover a profit as well, but we'll talk about that in a bit more detail soon. This is another one. The first 3 tasks on this exam are all worth 24 marks. It's quite chunky. You're needing to spend about half an hour per task. So by the time you get on this task, you're probably going to be at about an hour into the exam, which is quite a lot, really, when you think about what you've had to do. But task 2 is very, very chunky indeed. So what sort of things are we looking at with this? So the main thing is that you'll be asked to do some sort of break-even analysis. As I say, this is the looking at how many units we need to sell in order to cover our costs. You may also have some element of a target profit in there. So it might be that the company wants to make a profit of £10,000 on top of those costs, and you have to factor that in, and that will alter how many units you need to sell. We're dealing very much with marginal costing here, so it's very much looking at just our variable costs. So only and then how much we've got left over to cover any fixed costs that we have. And we come across this word contribution, which is ideally how much we've got left in terms of leftover profit that we can also cover our fixed costs with. Let's put the contribution. So in a nutshell, contribution, as it says here, I want to put it in a different colour just because I think it is worth having a different colour. It's our selling price less all variable costs. Yeah. So things like direct materials and direct labour, we know that they are variable costs. However, people often see the word overheads and think, oh, overheads are fixed costs. But you do have some variable overheads and you need to factor those in as well if you are given them in a question, which is very likely. Then I'll check if you know what you're talking about. You will be asked to complete and calculate a few different calculations to do this. And you've got them all here. This is quite a good sort of box of information to remember. Yeah, so you've got things like target, so break-even point in units. That's usually the starting point where you're looking at what you've got in terms of fixed cost and divide that by the contribution per unit. You'll probably have had to calculate the contribution per unit previous to that point as well, and we'll have a look at questions relating to that in a little bit. The other one that you might be asked is your break-even revenue. So once you've got that break-even point, you can then start to do other things like calculate your break-even revenue. So what's the number of units you need to sell in order to break even? That's your break-even point. And then you multiply that by your sales price. So you know how much revenue you need to get in to cover your costs in total. We then also can look at things called margin of safety. And this is where we look at what we're planning to produce versus what we need to produce in order to make sure we cover our costs, our break-even point. So again, if you go into the margin of safety in units, it's quite nice and straightforward. We'll take what we've budgeted to produce less the units that we need to produce our break-even point figure. So that's quite a nice one. But then it can get a bit more tricky in that you're asked to not only calculate potentially margin of safety as a percentage of your budget, but also margin of safety in terms of your selling price. So you can see the margin of safety in revenue is very similar to break-even revenue. So you're doing a number of units, whether that is your break-even point or your margin of safety, depending on which thing we're looking at, and then you're always going to multiply by your sales price. The margin of safety, if you're looking at it as a percentage of budget, it's always the difference between what you're planning to produce and what you need to produce. So your budget volume, less your break-even point. But then you always divide by your budgeted volume. You don't divide by your break-even point or anything like that. That would send it way off, not anything that needs to be. The other thing that you might be asked to do, and it's a similar calculation, but it takes it a little bit differently, is, like I say, if a company wants to achieve a certain level of profit on top of these costs that they need to cover, then it might be that you're asked to work out the number of units that you're needing to sell in order to achieve that goal. So you would look at what your fixed costs are plus any target profit, and then you're going to divide that by your contribution. So you can see again, it's similar to what we're doing with break-even point, but just adding that target profit into our calculation rather than just being the fixed costs. So yeah, quite a lot that you might need to be asked to do there. So it's important that you know these calculations and you know what you need to do for them, because it will get you a lot of marks on this exam. You may also be asked to do some changes in kind of budgetary information. So you might be asked to look at changes to prices in terms of what we're selling the product. So, you know, if we're going to have a change in the selling price, it might be that the price goes up, and that in which case we're going to have more money coming in, and therefore we're going to have less units that we need to cover our fixed costs. The fixed costs will stay the same. If we've got more money coming in terms of revenue because we've increased our selling price, we need fewer units to cover our fixed costs. Yeah. So usually if the selling price goes up, that means that your margin of safety, your break-even point goes down. And also your margin of safety goes up. I'm going to change margin of safety to MOS. That tends to go up because you're going to have a lower break-even point. There's more gap between your break-even point and the number of units that you're planning to sell. You may also come across changes in your variable costs. So it might be that your material or your labour costs will go up. If they go up, then that means that you've got more costs and less contribution per unit to be able to cover your fixed costs. So usually if your variable costs go up, that will mean your break-even point has to go up to match it. Yeah. Obviously, if these things go down, it does the opposite of what we're saying here. Yeah. So your break-even point on that one is going to go up, but your margin of safety will go down because we've got less units to cover. If our margin of safety, imagine if our margin of safety is kind of here at 5,000 units, we're planning to produce 10,000. If we increase our variable costs, it means that we've now got to produce 7,000 units in order to cover those costs. We've got less of a gap up to our 10,000 that we're planning to produce. That's our margin of safety going down. Margin of safety up to the gap between what we're planning to produce and what we need to produce. Similarly but differently, you might also be told that your fixed costs are changing, going up or going down. A bit like with the variable costs, if your fixed costs are going to increase, then you again need to sell more units to cover those fixed costs that have gone up. So you will increase your break-even point and it will decrease your margin of safety as well. So it's the same as you've got in this situation here, same as that. Yeah, same as that. The other thing that you might be asked to do, although we haven't actually got a question on this tonight, is to look at the difference between absorption costing and marginal costing. Now, what we've talked about tonight so far is very much along this marginal costing line. Okay, and what we do with that basically is that we are concentrating mainly on our variable costs. So that's our direct labour, our direct materials, our variable related overheads to production. we don't factor in any fixed costs into the product cost itself. And that's why we have this contribution that we then put forward to cover the fixed costs. With absorption costing, we call this full costing because it does everything. Yeah, so it will also include any production related fixed costs as well. So we're making sure that when we are costing out a product, we are covering everything. And that's why it's a bit more in depth and a bit more full. Yeah, so we don't include non-production related costs in that. So we wouldn't include like our administration costs, our office costs, those sorts of things that a business will need to have in order to run, but they're not directly related to production. So very much focusing on production related costs only with a task like this. They may throw in some non-production costs to fool you and trick you. Just make sure that you're knowing what you're talking about when you're answering the questions like this. So there's quite a lot in there, but the bulk of it is going to be around the short-term decision making that we talked about at the beginning. So I think we'll have a look at some questions now. There's a lot of information in these tasks as well, so it's going to be an element of scrolling up and down. But what I'll do is I'll try and put the workings next to each box so you can see where the figures are coming from. So we're given a scenario company, which is Gabriel Limited in this case, and we're given the cost card of the sort of budgeted costs on our standard cost card for the product that we're calling GH4, which is very imaginatively named. So we are told we've got our variable costs here, which are made up of direct materials and direct labour, and we've got those per unit, which is really nice. And then we've got some variable overheads, which may also feature. And then we've got our fixed overheads. But we're told also in there we've got like our total variable costs added up, which might be very useful. We've also got our completely total costs, which again may or may not be useful. We're also told that they are planning to sell, let's get a different colour, let's go with blue this time, that they've got a selling price of £80 per unit. So that's going to be needed because we need to know our selling price if we're going to be doing some short-term decision-making calculation. And also that they are planning to sell 3,000 units. So budgeted sales volume, 3,000 units, that's what they're planning to sell. So hopefully they will be able to cover their costs with those 3,000 units. So we've got a few sections on this, and we've got quite a few that relate to this. So we'll start at the top, which is a very good place to go with. What they are asking us to do first is to calculate the budgeted fixed overheads for GH4. Okay, so what do we need to do for this? Any thoughts in the chat box before I dive right in? What are we going to be using in order to find out what our budgeted fixed overheads are? What things are we going to need to use from the data that we've got? Bearing in mind, we're talking about the total fixed overheads here. Lovely, thank you. Yes, so what we're going to do is we're going to take our budgeted sales volume, which is 3,000 units, times by our £10 per unit, which should give us £30,000, which I think was mentioned in the chat. Yep. Tell you what I'll do. I'll just highlight the different colours. Hoping this will come out all right because it's blue on blue. So you can see where the figures are coming from. Yeah, so you can see. In fact, yeah, that's all right. I can do that. That's fine. So yeah, £30,000 for that first one. Right, we've now got to delve a little bit deeper because they now want to know what our break-even volume is. So we're going to be using that figure that we calculated in part A, which is why we started with that. Yeah. So what do we know? What do we need for our break-even volume? Let me have a chance to have a look at that. Let me see what you think. What do we need to know in order to get break-even volume? Yeah, well done, Carol. Yeah, so we first need to find out what our contribution is. In fact, I'm going to put this up here because it's going to be useful. So what's our contribution per unit? Yeah, so we're told that our selling price is £80 a unit. Yeah. And then we've got, excuse me, one second. Oh, got it. We're then told that we've got variable costs that total £60. Yeah. So if we take those away, we'll get a contribution per unit of £20. So that's our first step in calculating our break-even volume, which we can then use to again go on and do other things as well. So we were told from part A that we calculated that our budgeted fixed overheads is going to be £30,000. So we divide that by our £20 contribution per unit, which comes down here, and that will give us 1,500 units, I'm expecting. I'm going to divide one by the other. Ooh, keep accidentally hitting the eraser. Okay, so we now know that in order to cover that £30,000, we need to make and sell 1,500 units. Okay, doesn't look like that's going to be a problem because we're planning on selling 3,000, so we're double what we need to do. Okay, so part C then, you find there's lots of sort of smaller questions on this task, which is quite good for getting the marks up. If you can start off at the right point, you're going to be good. So it says for part C that using our answer from part B, so that's going to be important, we need to calculate our margin of safety, both in units, but also the percentage as well, which is where it gets a little bit more tricky. If they sell 2,000 units instead. Okay. So we'll have a look at what our margin of safety is in units first of all. So we knew that our break-even point from part B was 1,500 units. So if we look at the difference between that and what we're planning, that should mean we've got a margin of safety of 500 units. Hopefully that's fairly, let's see where I've got those figures from. Yes, they've had to come back down to selling 2,000 units instead, but they've still got that margin of, sorry, I've still got that break-even volume of 1,500 units. So we're looking at the difference between the two. This is where it gets tricky because they now want to know what the margin of safety is in percentage terms. Now, if you remember, what I said was that when you've got your margin of safety in units, to get the percentage, you divide that by your planned production. So your budgeted number of units that you're going to sell. So in this case, what we're going to do, we'll take our 500 units and we will divide that by the 2,000 that we've planned. Yeah, and then we want to times that by 100 to get it into a percentage. So I think we're going to be on 25%. Yeah, lovely. Oh, that's lovely. I've got some answers in the chat. So 25%, which isn't the worst in terms of margin of safety because it's a huge amount of wiggle room if sales don't go as planned. Right, this is where things get a little bit more tricky because we're now going to be looking at what happens if they make some further changes to the pricing on this product. So they're looking to increase the selling price of GH4, but all the costs will stay the same. So we need to have a look at what impact that will have on both the break-even point and the margin of safety, assuming no change in sales demand. So they are still planning to sell those 2,000 units that they had talked about in part C. But now the selling price is going up. So what happens? What happens if our selling price goes up? Do we have more or less money to play with, given that our costs are staying the same? So we'll go back. I'll go up and have a look at this beginning bit. So yeah, we're going to have more money to play with. If you imagine if we came along and went, oh, actually, well, we said our selling price was £80, but actually, if we make it 85, we've now got £25 per unit to play with. So we've got more contribution per unit in order to cover our costs. I will just change that back so that you're not confused for when you look at these notes later and you get the recording. But that's the point. If your selling price goes up and your costs are staying the same, you've got more contribution per unit. So we've got more money per unit in order to cover our fixed costs. So what happens to our break-even point? What happens to the number of units that we need to produce in order to cover our fixed costs? Well done, Carol. Yes, it will decrease. Yeah, so we've got more money to play with. We've got more contribution per unit. Which means less units are needed to cover the cost. Yeah. If I turned around and said, oh, if we look back to part B, and I said, actually, now we've got £25 per unit to play with. If you do 30,000 divided by 25, it actually means that you've got 1,200 units as your break-even point. So you've got less units that you need to make in order to cover all those fixed costs. What about your margin of safety? As this is the difference between what we're planning to sell and what we need to sell. We've got a lower break-even point. What happens to the margin of safety? What happens to that gap between the plan and what's needed? Yeah, well done. Yeah, so if the break-even point is going to go down, think about it. Go back to that thing we said about, you know, if you're going to make 10,000 units and you need to make 5,000. If 5,000 is your break-even point, if your break-even point suddenly drops down to 3,000, instead of having 5,000 as your gap, you've now got 7,000 as your gap. So you've got more units, and therefore your margin of safety increases. Yeah. That's a bit of a weird one to get your head around for some students, but hopefully that makes sense, and me doing all that with my hands has made a bit of an impact. Now then, we mentioned in the task briefing that sometimes they can ask you to, we'll just go there for now. They can also ask you that to include a bit of a target profit within your costs and in your calculation. This isn't the worst thing in the world, because all you're going to need to do is add that target profit onto your fixed costs and then sort out your break-even point in the same way as you would do if there was no target profit. You would just put up fixed costs. Okay, so Gabriel wished to make a profit of £12,000 on this product now. So we now need to calculate the number of units that he needs to sell to achieve the target profit. We are going to assume that all the figures are as originally based. We're not going to look at this, you know, part C and part D. We're going to look at our plan from the original figures at the very beginning of the task. So we're looking at all this information in the table and then the budgeted volume of 3,000 units. Okay, so he wants to make a profit of £12,000. We've got to work out, first of all, what our break-even point is if we do that. So we had, if you remember, we had budgeted fixed overheads of 30,000. Yep, so our overheads of 30,000. We've now got a profit to make and cover of £12,000. So we've now, instead of covering 30,000 like we had before, we've now got to cover £42,000, which is going to mean we've got to sell more units, basically. We've got more costs to cover. We said originally that our contribution per unit was £20, and we've still got that as an issue. So if we do, I'm just going to continue it down here. If we do our £42,000 of total costs and divide by that contribution per unit, we should now have to sell 2,100 units. And that's our new break-even point. Yeah, that's our answer. So we've gone up by 600 units actually. We needed to sell 1,500 before, didn't we? Okay. We've now got to look at the margin of safety in units, also percentage, and also in pounds as well. We've not done revenue before for margin of safety. I'm going to try and squeeze in these calculations as best I can. I'll start up here and we'll see how we get on. So we were planning to sell 3,000 units as we had at the start. Yep. And we take off what we need to sell, which is our 2,100 units. So our margin of safety in units is now 900 units. Not a lot. We can then work out the margin of safety percentage. I'll just do the calculation here. We're going to take our 900 units, divide by the plan, then obviously times by 100 to get that, and that will bring us out. It looks to be about 30% to me, but I'll just double check it. Yeah, 30%. Yeah. Now then, how we do the margin of safety revenue is a little bit different. Okay. So what we do is we look at the number of units in the margin of safety. Again, that's our 900. And we multiply it by our selling price per unit, which is that £8 that we had originally. Yep. So we're going to do 900 times by our selling price. So our margin of safety in units multiplied by our sales price, overall sales price. So that should give us £72,000. So on top of what we need to make to cover our costs and that target profit, we're going to have another £72,000. Quite nice. Not too bad. But those are some really good examples of typical questions that you might get on this task 3 for those short-term decision makers. Right, we've now got another section to do, which is where we're adjusting budgetary information to take into account the different things we need to know. We've got another product now that the same company produces, and we've got a table on the next page with our budgetary information to show what's going to happen. So the team are trying to decide whether it's worth trying to increase the production of this product up to 1,500 units, but only producing 1,000 units at the moment. If they do up the production, then they will need to make some changes. So they will, they're going to reduce the selling price by 2% to try and make it more attractive as a product to buy, because they do need to sell all of these extra units. They will also be able to decrease their variable material costs by 5%, probably because they're going to be able to buy more material in bulk. It's a bit of an extra thing for you, but if they're going to buy more material, the supplier may give them some discount. However, their variable labour costs are going to increase by 8% for each unit. So that's where it gets a little bit more tricky in what we need to do. So we'll have a look at the information on the table. I think what we'll do is we'll make some notes next to them. So if we remember that we said that the selling price is going to be down 2%. The material costs are also going to be down by 5%, but then the labour is going to be up by 8%. So we need to have a look at those as part of our calculations. And hopefully, I don't have any space, have I really? I'll tell you what, I'll move those and I'll move them and put them here so it's just a bit easier. So that's going down 2%. Sorry, I should have thought about this before I did it, but I just want a bit of space on the side. So we've been given the data for 1,000 units, but we need to make some adjustments for 1,500 units. Now, ordinarily, this would be really nice and straightforward because we generally be doing kind of flexing of the budget, but that will come in a different task. We've got to factor in the changes in the price. Yeah. So first thing I'm going to look at is I'm going to say that the other thing we need to know is the fixed costs are going to remain the same. Yeah, so we've got some fixed costs as well, but that will make it a little bit easier. Okay, so first thing we'll have a look at is we'll have a look at our sales price. Yeah, so the original cost per unit, we'll start looking at cost per unit here. Oh, there we go. So if we do 6,000 divided by the 1,000 units that we originally had, at 1,000 units, our sales price is going to be £6 per unit. However, we've got to factor in that the cost is going to go down. We need to take 2% off that. So you can do this kind of two ways, really. You can either calculate 2% of £6 and take off the few pence it will be, or you can calculate 98%, because that's the 100 less 2%, and then that will help you to do that. So what I think we'll do is we'll do it this side. So I'm going to do 6 times 2% equals, I think it's like 12p. Yeah, so that'll be 0.12, and then we'll do 6 minus 0.12 to get what our answer is going to be. It's £5.88 per unit. Yeah, so that's now going to be £5.88. We can then multiply £5.88 by a number of units to get the new total revenue for selling those 1,500 units. I hope that makes sense. We're going to do a similar thing with the variable costs. We're losing 5% of those, but again, they're variable, so they're dependent on production level. So if we divide our 3,400 by the 1,000 units, these are some nice easy calculations. Oh, we're going to get £3.40. There we go, per unit, which is what it was. However, it's going to become 5% less. Again, similar to what we did with the revenue, we can look at our variable as £3.40 times by 5% this time, which comes out at 17 pence. Yep, and then take that off. Get you £3.23. Yep, so that's now going to be £3.23. We multiply that up by the 1,500. 4,845. Yeah. Okay. So last one that we will need to do something with in real depth, I think, is our labour costs. So again, nice easy calculation to kick off with, £1,800 for 1,000 units, which means that it's £1.80 per unit. This is a bit different again, because this one, the costs are going to be going up, so we're going to have an increase even if we weren't changing our units, even though we are. Yep, so it's going up 8%. It'll be £1.80 times by 8%, which equals, oh, it doesn't quite go nicely, but we'll say it comes out at 0.144, which I will keep together for now. We'll add that on to our £1.80, and we'll round at the very end. Yeah, so that's now 1.944. Yeah, we want to keep it very much rounding at the very end whenever we're doing any costing data. We'll multiply that by the 1,500 units, which gets us a nice round figure of 2,916. But you can see that if I've rounded that down, if I just did 1.94 and times it by the 1,500, I would be £6 out, which, although it isn't a lot of money, we need to make sure we're getting it right. So whenever you're doing anything where you've got figures that aren't two decimal places naturally, keep it as it is on your calculator until you've got to a very, very final point, and then you can make that decision of whether you need to round up or down. If you start rounding during the calculation process, that tends to be where your answers will start to go awry. Right, now then, some students will fall into the gap of doing some sort of flexing on the contribution. You don't need to do that. All you need to do is take your revenue and take off your variable costs. So do 8820 minus 4845 minus 2916, which should give us a contribution of 1059. Yeah, it won't work if you do it the other way around. You've got those changes in price. Yeah, it doesn't work out. We've then got our fixed costs. Yeah, the clue is in the name. They are fixed. They will not change. So you don't need to do any kind of dividing by 1,000 and times up. It's a fixed cost. Don't fall into that trap. It stays at 550 regardless of whether we produce 1 unit or we produce 20,000. It will always be 550. So the final thing to do is just take that off, and we'll get our, looks like a profit. So we should now be making a profit of 509 on that product, which is pretty good because we've doubled our profit by only making 500 more units. That's quite good, really. Right, to finish off then, we're going to have a look at some true or false statements, and AAT do love these. Okay. So, we've got 3 statements here. We've got to decide whether they're true or false. We'll have a look at each one in turn and decide, and then we'll move on. So, if you have a new supplier who charges an extra 50p per kilo of material that you're buying for product GD1, is the contribution per unit is going to increase. Yeah, so if you've got more cost for your material, are you going to have an increased contribution per unit? What do you think? Is that true or false? Bearing in mind we talked about at the beginning about changes in cost. Yeah, well done. It's false. Yeah, if you've got higher costs, you've got a lower contribution. You've got less spare money in effect, because you know, think about it. If you've gone, like we were saying, if you've gone from having a selling price of £80 and variable costs of £60 to say how much with your contribution of 20, if those variable costs go up to 65, take that off your 80, you only get £15. So you've got less contribution and less money that you can put toward those fixed costs. Right, next one. The total variable cost stays the same at all volumes of output. True or false? Well, I think about this is about cost behaviour now, and whether our costs, our total costs, will remain the same if they're variable costs if we've got more units, or if we go down for less units. I think. True or false? Yeah, that one is false as well. It directly relates to output. So if you've got more units, you've got more units, you're going to have more cost overall on those variable costs because you've got more units that you need to, more material that you've got to buy, or more labour hours you've got to pay your staff for because you've made some more units. Right, again, and this is another cost behaviour question. So a mixed cost is one which has a variable and a fixed element to it. True or false? Hopefully not too bad a question. Yeah, well done. For those of you that will have done study on the previous syllabus, your mixed cost is what we also used to call a semi-variable cost. Yeah, remember that one. Yeah, exactly. Someone just said in the chat about your phone bill that you may have a fixed element in terms of, I don't think line rental is a thing anymore, but yeah, it used to be like you pay the line rental and then you pay so much for having your how many step cost is different because steps is where you're starting. You have to meet certain conditions to move up to the next step. So yeah, no, step cost is different to semi-variable / mixed cost. Yeah, no worries. Right, so that kind of brings us to the end of task 3. And those first 3 tasks are the really chunky ones on the unit. So once you've kind of got that, sorry, I've just seen a question pop up. Yes, yes. So step cost, it's also sometimes known as a step fixed cost, because it's usually a really good example, which I'm sure you would have seen in your notes, is where you've got maybe a supervisor's role. So for every, I don't know, 100,000 units that the production line will produce, you need a supervisor. And then technically, if you go to, I don't know, 100,001, you need a second supervisor. But one supervisor might be paid, I don't know, £25,000. You get a second supervisor, you've got another £25,000. So we'll see that as your production increases, it kind of steps up like that, because you're having to take on an extra person once you meet those conditions. In an ideal world, we know in the real world that probably won't be what happens, because it's not quite as faultless as that. But yeah, that's the idea with your step cost. Right, I'm going to bring things to a close. But thank you very much for attending. I hope it's been useful. I hope that gives you some confidence for task 3. We'll have a look at task 4 next time. But yeah, and if you need anything, this is where we are. But yeah, hope you've enjoyed that.